This is a Farm Doc Daily webinar on University of Illinois Extension's Todd Gleason. Today, we begin the first in a six-part series, the Illinois Farm Economics Summit. Today, we'll talk about the grain market outlook with Joe Jansen. He is an agricultural economist here on the Urbana-Champaign campus of the University of Illinois. Good morning to you, Joe. Thanks for being with us, and we look forward to your presentation.
Yeah, thanks a lot, Todd. It was great to have Todd and the whole Farm Doc team out on the road in December. But a lot has changed in the grain markets as we've discussed, and so we're gonna run through all that today. We'll talk a little bit about just sort of recent price action. We'll talk some about the state of sort of the old crop supply and demand situation. How factors all around the world are influencing the grain prices that we see here in Illinois, and then a little bit about sort of where do we go into 2025. So the beginning of the year, always a time for reflection and thinking about sort of where do we go from here as a new year starts. So we'll cover all those things and then really think about what that means for the marketing decisions that farmers have to make, both with the crop that they grew back in 2024 and then the crop that we plan to put in the ground in 2025. So that's where we're going to head. Probably the best place to start, as far as where I typically start, is to think about where we've come from. Not because that sort of provides any sort of prediction, but where we have come from sets up where we're going to go. And so these graphs just show sort of what has happened to corn and soybean prices, and I won't sort of surprise anyone with the idea that prices have fallen to longer run lower levels. We have a great analysis by my Farm Doc team colleagues, by Scott Irwin, on sort of what are the long run price levels that we would think should persist over time. Something in that sort of low $4 corn and around $10 soybeans. That's where we got to after harvest this year. We saw crop prices fall through the summer, basically on the idea that there was a pretty significant U.S. crop, both for corn and soybeans, coming in 2024. That was realized. Now, since then, that soybean market kind of ground sideways. We've stayed right around that $10 mark, with the exception of what's happened in the last week or so. Although, my phone informs me that the soybean market is off again about 20 cents this morning. So we're down kind of in that very low $10 place, kind of where we have been for the last 4 months. For corn, we have seen prices rally. Part of that is on expectations about what kind of crop we did have in 2024 for corn in the U.S. Part of that is some demand strength that we'll talk about here in just a few minutes. And the big surprise right at the end of that orange line on that graph is the corn price jumping significantly. Now we're still hanging out at a level around $4.75 per bushel on the board for nearby futures. Along with sort of this price level, we do want to think more generally about sort of other components of price that are doing the work of balancing supply and demand. So to do that, I look at what's happened to futures carry. That is the difference in the calendar spread between a distant futures month like July, sort of the end of this current marketing year, and the nearby futures, the March futures for both soybeans and corn. When we saw that big decline in prices in the summer, we did see significant move in carry to widen out and incentivize both farmers and other people in the grain supply chain to kind of hold some of that supply off the market, hold it back, and kind of like balance supply in the short run. So we saw carries widen, particularly in the soybean market, from around 8 cents out to almost 25 cents per bushel, and we've kind of been in that range for the last few months. We have seen, a similar story in corn, a build and carry through the summer that now actually has kind of been eroded. And the market is saying, kind of bring some of that corn to market. We're using corn at a fairly good pace, and the carry has kind of been eroded out of the corn market. The other component of the price history that I think is important to look at here, we can only really look since the fall, since that typical harvest time low, look at what's happened to basis, that is local crop prices. Here, these basis levels represent an average throughout the state of Illinois. We see right around the beginning of October, that's typically our seasonal basis low, as you know, we're in the gut slot of harvest, and the market is saying, you know, only bring us what you absolutely need. We know that the supply situation is fairly loose at that moment, but we have seen significant basis appreciation, both for corn and soybeans through the fall. Again, sort of a change in what we thought was sort of a very well supplied market to maybe a slightly less well supplied market, and we'll put some numbers on that in just a minute. So we had this post harvest basis appreciation. A little bit of that is now fading in the last little bit, but the market is saying, you know, we're maybe not quite as well supplied as we thought. The real question is sort of, where do we go from here? For the old crop market situation, that's really less a story about production, particularly once we got that January crop production report that suggested, and I'll talk about this more in a minute, that maybe the US crop from 2024 wasn't quite as big as we thought. Really, we're in sort of a largely demand-driven market. And then it helps us to think maybe a little bit about sort of what components of that demand pie are the biggest, and where might we see changes in expected, supply and demand, in the sort of supply and demand balance through the next 6 months. So we really have to think about demand for both corn and soybeans as having kind of four components, and they're really sort of the same thing. I've kind of labeled them with the same colors in these two pies to kind of indicate that a big component of demand for both corn and soybeans is domestic feed. That's the green piece of these pies. Relatively similar, sort of somewhere between a third and a half for both corn and soybeans. So 38% of corn demand is feed. Domestic meal production is about 46% of demand this year. So that piece can be big. But it's a domestic demand. It's not necessarily quite as flexible as some of the other pieces of this pie. The same story sort of holds true for biofuels. Again, relatively inflexible because a lot of it is driven by mandates put forth in legislation. But the thing to note is that the ethanol piece for corn is substantially larger than the use of soybean oil for biofuels as a percentage of overall production of corn and soybeans. So in terms of thinking about all use, biofuels, those orange slices, important but much larger for corn. We have that domestic food demand piece, which is in the blue, which tends to be pretty small. And then the part that I'm going to spend a lot of time talking about today, that export demand piece, smaller for corn than it is for beans, but it really is the shock absorber. When we sort of get a little bit more supply coming to the market, it's exports that can pick up some of that slack and can back off if prices get higher. That's a place where we sort of see maybe a little bit more demand rationing. Now, the export piece is smaller for corn than it is for soybeans. So there can be bigger swings given sort of the size of that export piece, bigger swings in the overall supply and demand picture. What does that supply and demand picture look like? Well, we go to the balance sheet. These are just USDA's baseline. I don't sort of have much to really change from what USDA is sort of setting forth as the baseline supply and demand picture. There's a couple of things, though, that I think we can highlight here, really in terms of what USDA changed in the January WASDE report that came out last week and the crop production report that came from NASS. The big number here is is that yield piece. So where we saw USDA lower that yield number, which was at a 183.1 down to 179.3. That's a massive move and really changed the nature of sort of what we thought about total available supply. So we thought there was going to be 17 billion bushel plus total supply available to the market here in 24-25, now significantly lower than that. So that really has changed our thinking about sort of the size of the crop. USDA did also back off their usage estimates in the January report, backing off the feed number by 50 million bushels, backing off their export number by 25 million bushels. So those things kind of, maybe dampened the blow, but this was a pretty significant move and really sort of put the wind in the sails of the corn market. Why? Because that number down at the bottom, the stocks to use ratio, we were expecting at one point stocks to use in the US to be much closer to 15% at the end of this current marketing year. We're now down right around that knife edge level of about 10%. That really hasn't sort of changed the bottom line number, USDA's season average price estimate, in part because a lot of that is already set in stone based on sales that have already been made. And that's, I know a source of consternation in the farm community, that, well, if we had only known, if USDA would have told us, I think, everyone's best guess about the size of this crop was something north of 180, and we just didn't quite get there. The dryness that we had during harvest really kind of affecting that situation. But getting a solid estimate of that was difficult until the crop was all in the bin. That does mean that there could be, that getting down to that low stocks to use level, around that 10% level, could really sort of mean bigger swings in corn prices. But we will see. I think there's some things that might mean sort of some of these gains might be reversed. On the soybean side, USDA did make similar changes to the yield estimate, lowering that soybean yield estimate for the US by about 1 bushel per acre from 51.7 down to 50.7 bushels per acre for a national average yield. Made no changes in terms of use, which again, usage for US soybeans has kind of been diverging over time. We've gotten sort of heavier on domestic use, lower on exports as the export markets become quite competitive, and we'll talk about that. But we're still sort of seeing, year over year build in, the level of stocks relative to use, and that's kind of what's weighing on the soybean market, or one of the big things weighing on the soybean market. The other being sort of the global picture, and we'll get to that in just a second. So the size of the crop now basically more or less being set. We tend not to see large swings after that January report. That's going to lead us to think about, well, what do we do in terms of demand going forward? Where might we see sort of deviations from the usage estimates given by USDA in its most recent updates? So we got to talk about old crop demand prospects. I'm going to spend a little bit of time thinking about biofuels demand, and I think we've got some news on biofuels demand that's come out in the last few weeks. But important to put that in some context. So the way I'm going to do that is just to think about, what does overall U.S. biofuels production look like? This graph just shows the sort of the three major types of biofuels production in the U.S. That is corn ethanol, FAME, or sort of traditional biodiesel that gets blended into the petroleum diesel supply, that boom in renewable diesel, a drop in replacement for petroleum diesel, and then all other biofuels, which might include things like sustainable aviation fuel, which we produce just a very small portion of. So we can see that, right, ethanol is the big player. The one big sort of thing in the last few months is, ethanol production has been pretty good. We've gotten back to that pre-COVID ethanol production level. We were producing about 1.4 billion gallons of ethanol per month pre-COVID at the sort of seasonal peak. We got back there in August and September of 2024. All indications are that, there's strong demand for corn for biofuels, but we're kind of in, this is not sort of significant change. A lot of talk has been about these other components of U.S. biofuels production, one being renewable diesel. And I think we may get some news about, with an incoming Trump administration, about the the ability for production incentives in the biofuel sector to favor domestic feedstocks versus imported feedstocks, particularly used cooking oil coming from Asia. That could be a significant source of maybe a little bit of demand optimism for the soybean sector in the next 6 months to a year. The other piece of sort of potential optimism, a lot of talk around incentives for sustainable aviation fuel production. And I just view that as kind of a longer run driver. One, existing sustainable aviation fuel production, really small. So in terms of our ability to turn that into feedstock demand in the short run is pretty limited. And then two, the policy environment there is incredibly uncertain. We've seen a little bit of guidance about the sort of the tax credit incentives of what everyone's calling 45Z for the piece of legislation, the section of legislation that's potentially providing incentive for the use of both ethanol and soybean oil as feedstocks in the production of sustainable aviation fuel. But I think more uncertainty there, and given the size of that not maybe a major price driver going forward. Where I think there might be sort of bigger room for changes in demand and the ability to move price is on the export sales side. So these graphs are just showing in the orange line the current pace of export sales and where we might need to get to in terms of meeting USDA's current expectations. So the market essentially, I think, is building in that solid blue line at the top, a total marketing year export level for corn right now of 2.45 billion bushels. I think we're right on pace to get there. We actually, this morning, after I produced this chart, of course, got some pretty optimistic news about corn export demand. Corn export sales for the week coming in more than higher than expected, a level that sort of like keep that uptrend in the orange line here going and get us to that 2.45 billion. So I think we're right on pace. We've had in the fall in particular, so you can see back in October and November, stronger than expected maybe export demand for corn. Coming from places like Mexico, places like South America. We've seen some flash sales recently to Southeast Asia, one sale in the last week to Taiwan. So all of those things sort of positives for the corn market, but basically putting us right on track to meet expectations in terms of where USDA has pegged marketing year exports. On the soybean side, I think there's a little bit more uncertainty. USDA's current WASDE forecast of 1.825 billion bushels, that blue line here, looks like a very achievable target if we base our expectations on sort of the 5-year average. I think the danger here and what we've seen is export demand for soybeans really dry up in the last few weeks over the December holidays. And if we continue on a pace like we saw last year, where the soybean export demand tap really kind of shut down after January of last year, if we see something similar, I think that USDA's expectations are pretty much right on, and that sort of seems to be what USDA is saying. With a Brazilian crop coming to market in the first half of 2025, that would sort of fill any holes in the global supply and demand picture. The United States really kind of needed to make its export sales early in this year. That appears to have happened, and so I think USDA's expectations for sort of total marketing year exports for soybeans appear to be in line with sort of what we can have as best guess about what's going forward. Big wild card in that, of course, is the potential for a trade conflict or conflicts once a Trump administration is inaugurated after next week. I won't go through and try and sort of quarterback or think about there are a whole set of tariff proposals. One of them back in December was, maybe slightly larger tariffs than we expected on imports from Canada and Mexico. slightly smaller additional tariffs imposed on China. Another proposal that's come out in the last week is sort of a gradual ratchet up in tariffs that will start small and just keep ratcheting up tariffs until we can achieve some policy goals. Now, the question is, what kind of damage does that impose along the way? Canada came out yesterday with a set of retaliatory tariff proposals. Here are the things that we're going to put tariffs on if you put tariffs on us. That tends to be, the news of those things tends to be negative for corn and soybean markets, which are heavily export dependent. And some of these countries, Canada and Mexico in particular for corn, soybeans for China, are big export destinations for the United States. To put this in some context, right, we just need to think about sort of like the role of ag in one of these tit-for-tat trade wars. The United States has significant ag exports to all three of those countries. More than $30 billion a year in ag exports to all of China, Mexico, and Canada. These numbers are a little bit dated, but they kind of encompass all of ag. So the value of ag is significant in absolute terms. It's also significant in terms of all of our goods trade. So ag as a share of goods trade to China is about a quarter. So if they are going to impose retaliatory tariffs on something, it's going to be agriculture, particularly in the case of China. On the other side, we don't have the ability, maybe as large an ability to impose tariffs on ag imports coming from these particular countries, particularly in the case of China. Maybe less so in the case of Mexico and Canada. And that's where, I'm not going to sort of try and, again, forecast a trade war, but I will say this tends to be not a bullish part of the future demand picture, simply because the potential for ag to get embroiled in a larger trade conflict is pretty significant given sort of the composition of our trade with these countries. The other component of the demand piece is South American production. We're getting a lot of news right now about weather in Argentina and Brazil. I won't sort of dwell too much on the Argentine production numbers. Some thought that there has been some dry weather in Argentina that might cause us to back off some of those production estimates a little bit. But I'm going to focus a little bit on Brazil because I think the story here is pretty stable corn production. That's maybe where we're sort of seeing maybe less headwinds in the export demand picture for corn because acreage in Brazil is basically flat year over year, maybe a slight increase in expected production forecast as of now. CONAB came out with its most recent numbers that didn't sort of change this picture much this week relative to previous expectations. But that Brazil government agency, CONAB, is still saying, there is a significant build year over year in Brazilian soybean acreage, and that is going to lead to a significant increase in Brazilian soybean production. These numbers did decline a little bit, only ever so slightly in the CONAB numbers that came out this week, but you can just look at that year over year change, 700 million bushels more of Brazilian soybean production relative to a year ago. So that's one thing that's going to kind of keep a lid on these markets going forward, is just the size of that South American crop, how important it is, particularly for Brazil, where they're producing essentially 1.5 times a U.S. crop in Brazil every year relative to what we're producing now. If that crop comes in as expected, these are the CONAB numbers. The other thing is sort of there is this discrepancy between CONAB and USDA estimates, but all indications are a pretty significant Brazilian crop coming. The other component of that, and where things get really difficult in export markets, is just the incentive for the Brazilian farmer and the Brazilian soybean industry to bring that crop to the export market. One thing that's really changed this year relative to last year is the strength in the US dollar, particularly relative to the Brazilian real. So we've had this story about strong US dollar. That's really been a story going back maybe to 2022 with the rise in interest rates in the United States, putting some strength in the US dollar. We've seen strength in the US dollar in the last few months. The US dollar index, which is just sort of measuring the value of the dollar relative to a basket of developed or liquid currencies, so mainly developed country currencies like the euro, Japanese yen, UK pound, have seen some appreciation there, but nothing like the appreciation we've seen of the US dollar relative to the real. That's going to create an incentive for Brazilian soybeans and Brazilian corn to come to global markets. And that has led to really a dominance of the Chinese soybean market, which is the biggest export destination around the world for soybeans, by Brazil, and kind of at the expense of the United States. Now, the United States has turned more towards domestic demand, as we've discussed, but you can really see, obviously, during the last trade war, a total dominance of that market by Brazil, and a conscious decision by Chinese importers to steer away from U.S. supplies. However, we did see strong demand for U.S. soybeans from China in 2020, 2021. That has really changed in the last year, and sort of every expectation is that this year kind of looks a lot like last year. We have seen some large export sales to China, but it's much more of a hand-to-mouth situation than we have seen in the past. How do we sort of summarize all of this? I think the chart that you want to look at is this one. Just what does the overall supply and demand picture look like globally for soybeans? We have seen, U.S. stocks to use ratio still kind of tight, under 10%. We're projecting, a sub 9%, I think, stocks to use ratio based on USDA numbers right now. But the global demand picture remains, remains one of a well-supplied market. So we've seen this build in global stocks to use year over year. We're projecting record global stocks levels, even with the change in U.S. production numbers from last week. So the last two bars just show sort of the global supply and demand picture for soybeans last month relative to this month. We did see, obviously, a little bit of a tightening, but overall, we're still going to be over 30% stocks to use globally for soybeans this year, even with that change in U.S. production. So I think the long run sort of thought is that this is going to keep a lid on particularly on the soybean market. Why we sort of seen the soybean market sort of grind sideways for 4 months is really this picture here. It would take major changes that I think we just don't expect right now in production in some part of the world, and that really has to be for soybeans in particular, South America or the United States. And I'll talk about why we maybe don't see that changing much, in part because we're getting pretty close to harvest for Brazil, in part because we're already projecting some decline in soybean acres in the United States, and I'll talk about that in just a second. So where do we go from here? The other big wild card is U.S. production. That's a thing that, yes, could be a significant source of higher prices in the future if we get some pullback in production in the United States. The thing that we have to recognize is that we are fighting against, I think, one of the most reliable trends in global agricultural commodity supply and demand, and that is this trend for higher yields year over year in the United States. We have seen linear yield growth for U.S. corn and soybeans for some time, and you just can't sort of bet against a trend that is reliable as this one. Now, we do get significant deviations from this. You can see sort of the gray lines here are a 35-year trend, which is roughly what USDA is using when they sort of think about trend line yields for next year. For corn, that dark gray line would put us at about 182 bushels per acre. That trend line yield number has maybe been adjusted down slightly because we've thrown out some low yield years like 1988 relatively recently, and because yield performance has been below trend, frankly, for some time in the United States for the last sort of 6 to 8 years. Still, our best guess is for year-over-year yield growth. And it is not out of the realm of possibility to see numbers, plus or minus 10 bushels from that trend. That would put us still at a plus 190 bushel per acre U.S. national average corn yield. Similar story for soybeans. Current best yield guess is about 52 bushels per acre. That's a bigger crop in the United States that we would have next year than we had this year. That's gonna weigh on prices to some degree, and particularly if we see sort of surprise to the upside. Now, the one thing that can change, right, the size of the overall crop is how many acres we allocate to one crop or another. And the market is certainly favoring more corn acres going into 2025 than it did a year ago. So we saw a roughly much closer to even split in corn acres relative to beans. Every expectation is that we're going to see bigger corn acres in 2025 than we saw in 2024. And that even we might have expected, say 3 to 4 months ago. So this graph just shows the new crop futures price ratio, sort of what do we expect in terms of relative prices for delivery after the next harvest. And that number is sort of below the sort of average level that we've seen, certainly favoring corn. And if you look at current price levels, it might be the price levels as of today might be an even stronger signal that we'll see more corn acres. We'll see more corn acres going forward. Pegging that number is a little bit difficult. So I do want to sort of think about the corn supply and demand balance sheet, where we were maybe a year ago or a few months ago in terms of our expectations for corn acres in the United States. USDA, when it set its baseline balance sheet for this coming marketing year, the 25-26 marketing year, had pegged a 92 million acres of corn. This is sort of where USDA sees the long run level for corn acres, roughly in that 92 million acres. I think every expectation for the market is that we're going to see a number north of that, given the incentive to plant corn. I'm currently pegging that at 94 million acres. I mean, you've seen people say things like 96 million acres, which would be a massive jump, strong skew towards corn acres. Something like we saw just a few years ago, where we had almost 94.5 million acres. This would be substantially more than that. But what that's going to do, particularly in the context of say USDA's baseline yield prediction at 182, or my expectation that we might see a number sort of a little bit north of that at maybe 183 bushels an acre. What that's going to do is really fill this balance sheet back up. And we could very quickly, my expectation is, and based on USDA's numbers, even with a smaller estimate of carryout for this current year, really fill that balance sheet back up and get us back to a stocks to use level that would be burdensome and something. And so my expectation is still that long run price level of something around $4 corn for the coming year, just on the fact that we're going to have a decent sized South American corn crop, and then on the heels of that, more corn production in the United States. Not to say that yield couldn't change that picture, but that's sort of what we'd have to expect. On the soybean balance sheet, this does maybe create a little bit of optimism, get us away from where we were. If we plug in USDA's baseline estimates, they were expecting a pretty significant build in stocks here. Stocks to use building to over 11% here in the United States. If we plug in sort of lower planted area estimates plus sort of current projections for yield, that trend line yield expectation around 52.5 bushels per acre, we're going to see a build in stocks to use, but nothing like nothing that would be quite as burdensome as we might have expected. So that's maybe a source of optimism. The counter to that is soybean price levels right now are frankly pretty poor from the perspective of the U.S. farmer. What does this all mean for farm marketing? That's kind of where I want to go next. And this is sort of some stuff that I've been talking about for a couple of years now, but I think it's good to reiterate and sort of think about in terms of how does it come into our marketing strategy. We've moved through January 1st, which the day that I view as the biggest day of the farmer marketing calendar, when we tend to see a lot of sales get made as we move into a new tax period. But overall, the farmer still has a marketing challenge, right? We've seen that a lot of farms are realizing very few new crop sales prior to January 1st. When margins are relatively tight, and we came out with new crop budgets for 2025-26 from the Farm Doc team this last week, still projecting negative margins. When margins are tight, we are cramming a lot of marketing activity into a fairly short window. And the research that we've done with farmers participating in Illinois FBFM suggests that the returns to post-harvest marketing, at least realized by farmers here in the state of Illinois, tend to be fairly limited. So the average realized gross return, not factoring in any costs associated with deferring sales, either in terms of physical storage costs or opportunity costs, are pretty small, 6 to 7%. For corn and soybeans. So that's farmers are realizing returns on sales that they make later in the marketing year that are not that far above what the crop sales that they made prior to January 1. That suggests that this marketing challenge is pretty difficult, and in a low margin environment, squeezing out some amount of return on the order of 6 to 7% could be significant. Now, how do we do that? Obviously, that's sort of using all the tools in our marketing toolkit. We've done some recent research with the Farm Doc team and a graduate student of mine here in the Department of ACE at Illinois, saying that using futures and option strategies does not have to be the core part of this. And indeed, it doesn't seem like that is a silver bullet panacea, sort of using futures and options as a marketing tool. We see that about 15% of farms in the state are using futures and options as part of their marketing toolkit in any given year. They have an active brokerage account and are trading futures and options. That group that sort of uses futures and options doesn't tend to sort of do a lot better in terms of their marketing performance. The range of price outcomes that they achieve, which I show in these right-hand graphs, is roughly similar to the ones for farmers who don't use futures at all. Not to say that futures and options can't be a useful tool, just that they're no silver bullet when it comes to marketing grain. What is important is thinking about sort of what am I giving up by waiting for higher prices in the future? And we're in a high interest rate environment. I don't expect that to change significantly. Even with an incoming Trump administration that certainly seems to want to favor lower interest rates, the Federal Reserve Bank still has the authority to set interest rates independent of the chief executive. And while we might see rate cuts in the future, not sort of to put us back in the kind of grain marketing environment we had where, the opportunity cost of deferring sales was pretty low if we go back into if we just go back even a couple of years. So really important then to think about what is the cost of grain marketing for farmers. Here I just show some simple return calculations. So if you sort of give, based on the prices that we see today, something around $4.75 corn on the board, what was $10.50 soybeans, we're maybe not quite there as of today, but if you wait to market this crop later in the year, if you sort of don't think this recent rally was big enough, what would you be giving up? What do you need to achieve to realize significant gains? So I've done some opportunity cost calculations where we think about what am I giving up by not selling at that current price level? That's about 1.5 cents per bushel per month for corn, 3.5 cents per bushel per month for soybeans. If you think that the opportunity cost of waiting is relatively small, if you're factoring in the sort of the full level of a higher level of opportunity cost based on, say, things like the interest rate on operating loans that farmers are facing right now, something closer to 8%, it's really difficult to pencil out positive returns given current expectations about higher prices in the year, the carry that's built into the grain market, and those and some factoring in of physical storage costs, which here I've based on commercial grain storage rates, but that could be deterioration and shrink and the cost of monitoring grain inventories. We're penciling out sort of some pretty limited returns, on the order of 8 to 10 cents per bushel, based on current carry that's in the market. And that's, again, I showed earlier some of that carry being eroded in the last few months. So some closing thoughts. I'd love to get to questions. We've got a couple in the chat already, but love to fill that question bin up with some more questions on the current grain marketing environment. The main thing to note is that crop prices have fallen to long-run average levels, but we have had this recent rally. And I think there's an open question about the extent to which that is an opportunity for the farmer to realize some sales and maybe move on to the challenge of marketing the 2025 crop. There is, like I said, there can be some positive returns to waiting in expectation, but those are not massive. And I think the farm really has to sort of think about how much longer they want to wait, particularly in the corn market where we've seen a rally. And I think you'd have to see something big that would move us north of current prices on the board. I mean, you'd have to see a move north of $5. And given the Brazilian crop that's coming, that's the likelihood of a significantly higher move again. Is you're betting on two big moves, not one. There are a whole set of bearish threats. We'll talk a little bit about tariffs in the Q&A period here, but that is the big wild card and one that could really reverse any gains that we've seen in the last month. The other thing to note, and the takeaway message from all of the work that I've done with looking at farmer grain marketing performance, and I kind of briefly touched on that here at the end of this talk. We've got some articles on Farm Doc Daily discussing this further that I encourage you to go check out. But the overall story is that crop marketing is a difficult game to win consistently. We don't see that particular farmers having a durable advantage where they tend to always market grain at the right time. So the one thing that you can do is have a marketing plan that commits you to consistent action. That's not controversial or sort of novel advice. I think the wins are small. So I think this recent rally in the corn market is a win for the farmer. It's about the size that I was sort of expecting, something on the order of 25, maybe to 50 cents per bushel. When I put these slides together back in December prior to the earlier IFES series, that's kind of what I'm looking at in terms of a win. And I think we saw that, a 25 cent rally, roughly speaking, in the corn market on the board relative to where things were at a month ago. I will say that taking advantage of that doesn't mean necessarily the use of sophisticated marketing tools. So you don't need a crazy futures and options strategy. What you need is a marketing plan and a marketing action that commits you to making real sales that realize gains. And you've got to calculate those gains net of the full cost. So important to note that this rally, right, did cost you in terms of having to wait some amount of time, eating into the gains, because you need to make back at least 2 or 3 cents per bushel per month to justify that action. So with that, we'll move into Q&A. Todd's back with me, and we'll maybe just briefly run through the support that we have here at the Farm Doc team, what allows us to keep bringing this kind of information to you. Thank our sponsors and our educational partners here at the Farm Doc.
You bet, Joe. We'll do that. So as we begin, Joe's asking that if you have questions, you put them into the question box. I did make note, if you manage to find that little pop-out button and you're on the desktop, the question, the question button is actually in the bar. I think you'll see it in the toolbar. Otherwise, it's probably up on the top on the right-hand side of your page, whether you're on the laptop or an iPad or a phone. If you have managed to pop things apart so it makes it easier across a couple of screens, then it's in the toolbar. And probably down at the bottom of the page as opposed to somewhere else, and that's only on a desktop. We do want to talk about some of our sponsors and thank them. They include the TIA Center for Farmland Research. That's right here on campus at the University of Illinois, part of the Farm Doc whole series of folks that are in the Ag Econ department. CoBank is a sponsor, Compeer Financial, Corteva AgriScience, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers, and of course the Illinois Soybean Association. Our educational partners include the College of Agricultural, Consumer, and Environmental Sciences, the College of ACES here on the Urbana-Champaign campus of the University of Illinois, and of course the Department of Agricultural and Consumer Economics, as well as Extension, FBFM, and the Gardner Agricultural Policy Program. A special shout out to the folks at FBFM, because many of the numbers that the Ag Economist, Joe, and the rest of the Farm Doc team use are developed from farms across the state in that farm record keeping system. And finally, remember that this webinar will be posted to our archive. You can get to it quickly and easily just by using YouTube, youtube.com/@FarmDoc, or go to our webpage at farmdocdaily.illinois.edu and look in the archive section. We do have a couple of questions that we probably ought to think about answering. The first one that came in, and this was early, Joe, was a question that gets asked all the time, which is if the president-elect levies tariffs on Chinese imports, it says in particular, but it would be imports of all sorts, who actually pays the tariff?
Well, so U.S. importers, the company in the United States that is buying whatever we buy from China and bringing it to the United States and selling it to U.S. consumers, that company actually has to write the check that pays the tariffs. But just like, and I point that this runs both ways. When we send exports to China, right, it's technically a Chinese importer that is, writing the check to the Chinese government that says, here's the money for the tariff. But the burden of the tariff kind of falls on both sides, right? It makes the product more expensive for whoever's consuming it, and it makes it less valuable for whoever's selling it. And so that's the real concern here, is that, it's technically not the U.S. farmer writing a check to the Chinese government if we want to sell them soybeans and pay a tariff. We're one to be imposed as part of a trade war, or additional tariffs be imposed and actually levied. There's an extent to which tariffs get announced but don't necessarily actually get charged. That's sort of been part of the implementation of the sort of cold trade war that's existed really since through the Biden administration. The question is whether this trade war gets hotter and those tariffs start to sort of really kick in. But the U.S. farmer would sort of bear some of the cost, in the sense that the soybeans that they were selling would no longer be quite as valuable because they have to jump that tariff wall. So that's a thing that economists love to talk about, is this idea that, the person physically writing the check is not necessarily the one who bears the full cost, right? The costs are borne by all sides of that trade. It's just sort of who's more willing to bend on price. Given the importance of the Chinese market for, say, U.S. soybean exports, it's likely to be the case that the U.S. farmer is going to have to give a bit on price to make soybeans attractive in the presence of significant new tariffs.
All right. So we do have a question related to the FBFM function, and they want to know what percent of the FBFM population utilizes the board or options or futures,
trading futures and options. Yeah.
Compared to those not affiliated with the FBFM. Did your survey get
difficult to get at that directly? There is some data. So USDA has done surveys. USDA conducts a pretty detailed survey of farm financial data that's relatable to the FBFM data, in the sense that they look at things like the farm balance sheet and income statement through what they call their ARMS survey, or Ag Resource Management Survey. And we can compare the results that we have for FBFM farmers to the national data that are available from USDA. So they do break that out by, say, corn farms that are primarily producing corn and soybeans. So we can think of that as, sort of pretty much that's, corn and soybean farms in the Corn Belt, which is a pretty comparable population to say grain farms in the Illinois FBFM. They find numbers that are maybe slightly lower, but that's, again, Corn Belt wide. And I would anticipate, my guess is that, farmers in Illinois tend to be a little bit larger in terms of farm size, maybe not in terms of acreage, but in terms of revenue. We're maybe slightly above, sort of the non-FBFM population, but in terms of, like, if you compared them to corn and soybean farmers in the Midwest as a whole, we do sort of see that, again, larger farmers tend to be more likely to use futures and options. But even then, not more than, say, 40-ish% of very large farms in the FBFM are active users of futures and options.
Yeah, I would also say
that answers that question.
This is just from experience, Joe. I would also say that proximity to Chicago, and mostly to the traders and the places that were being developed over time in the 70s, particularly in the 80s and the 90s, meant that producers that lived closer to those people who were giving them advice, mostly around Chicago area, were likely to cause farmers in Illinois, Wisconsin, maybe Michigan, Indiana to use the markets a bit more as well. Question here, in your opinion, what do you think caused the USDA to drop the yield estimates so significantly from the November report?
I don't know. It's hard to believe we had an almost 4 bushel change in the U.S. national corn yield. So I'm still sort of a little bit in, not disbelief, but that's a big change. I mean, the one that everyone's talking about is just the dryness that occurred during harvest. And if you go back to sort of that price history, you do see a little bit of a modest move in price levels at that time. Sort of the idea that we're taking this crop off really dry. We sort of adjust that to sort of standard bushel measure. Based on moisture, typical moisture content, say 15% for corn, that's going to mean fewer bushels because there's less weight there than there otherwise would be. I think part of it is that dryness. Maybe it didn't change the size of the crop, but it made it harder to estimate and get a handle on back in October or November, relative to sort of, with the benefit of hindsight, once that grain is in a bin, actually getting delivered to the elevator, getting scaled. What that made that harder to estimate. But it is such a big swing, and it is a little bit, hard to imagine that we'd swing quite so hard in the midst of, from one report to the next. It is a little baffling. I mean, I know you've got thoughts on this too, Todd. So let's have that conversation.
In this case, USDA, of course, was taking into consideration the survey they did of farmers and what they believe and what they make note of as their harvest, total harvest for the year, and what their averages were. So as long as they had good paperwork, and depending on whether they're putting it in the bin or not, which oftentimes is interesting, because a 10,000 or 30,000 or a 50,000 bushel bin holds that by volume, but weight is different. And sometimes it's a lot more and a lot less than that. So there still could be some things that change over time, I would think.
Yeah, this would be actually a really interesting thing to look at. I mean, you have much of the rest of the world that's measuring output in terms of typically in terms of metric tons or kilograms or some weight measure, and we have this system of expressing harvest in a volume measure that we've converted from weight, and might be an interesting thing to look at in the wake of what's happened this year, to think about, is this problem a sort of uniquely American problem or not? Not that it may not be an issue for a long time again, but there will be a year where we harvest a dry corn crop, and we might want to think about what how we should sort of maybe factor that into our expectations in a clearer way, given the way that this, surprised the market.
Oh, I hope you do that. I feel like that could be a very interesting project to take a look at. That brings us to a couple of other things. As we preface this last question, which is about weather risk in South America and whether that's still there, I made note that you had converted from metric tons to bushels,
Yeah.
the Brazilian and Argentine crops, or at least the Brazilian crop. And if folks are I find metric tons difficult to think about because I'm used to thinking about bushels. I wish the United States had made that conversion, or at least the Board of Trade had in the 1970s when I was young. We started that way. We did not. If you're interested in seeing those numbers, I post the CONAB numbers when they're released. They're every month at this point, like USDA does, to the willag.org website, the WILL radio website, willag.org. Under the USDA tab, both the current USDA numbers as well as the CONAB numbers, and I have them converted to bushels for people to see. Do you think there is weather risk still, Joe, in this marketplace yet to come?
The short answer is yes. The long answer is my ability to sort of tell you sort of the specifics of what might happen are pretty limited. I mean, there are better people on South American weather. Leads really well into one of our forthcoming IFES webinars, which is my colleague Joanna Calusi talking specifically about South American crop prospects. So you should tune in and listen to Joanna. When we, if that's a big question. I mean, yes, there's weather risk, in particularly for that corn crop, that second crop corn, that is like much of that corn production number is, a far way from being realized, in part because, that crop hasn't been planted yet. Will get planted in the next quarter in this, in 2025. And that means a lot of water under the bridge in terms of weather events that need to get us to that production estimate. So yes, there's a lot of risk, probably a little bit more of it on corn than beans, because we are getting pretty close to the heart of bean harvest in South America. So
we have reached the top of the hour. You did remind me that Joanna is up next Thursday, in fact, talking about the South American crop season. If you're watching us live, you're already signed up for that. If you're checking us out on YouTube and you've not watched us live, you can do that by signing up for the webinars at farmdocdaily.illinois.edu. Joe Jansen, thank you so much for being with us. He's an agricultural economist at the University of Illinois, and thanks to Jim Boltz behind the scenes, making sure that everything is going well. He's the TD, or the technical director, and thank you for bearing with us on this very first time that we've used a brand new format for the Go To Webinar series. We appreciate your patience on that end. You have a very good day.